Hey, what's up, stock compounders? Brad here. So Monish Pabrai gave us another fantastic talk at a business school. This one was on February 9th, just released on the 25th of February, so just a few days ago. And as always, I want to go through and share my highlights from this talk at Babson, the first time Pabrai has done a talk at Babson. So let's jump right in. First of all, Pabrai points out the uniqueness of Babson. Okay, apparently Babson has an entrepreneurship program. Most business schools don't teach entrepreneurship. Pabrai says entrepreneurship is a neglected area in business schools, and the reason for that was interesting. Generally, business school professors will find it hard to get consulting assignments if they specialize in entrepreneurship. If you're a business school professor, you specialize in branding or leadership or organizational development, marketing, something that will enable you to have a lush consulting career on the side. All right. Entrepreneurs aren't going to pay business school professors as consultants. To teach entrepreneurship well, you must have been a practitioner. And he goes on to say, generally speaking, entrepreneurs don't have PhDs and the credentials. As a result, entrepreneurship is largely ignored in business schools. So it's just kind of an interesting thing how, entrepreneurs and academia, they tend to be largely separate, which is just kind of an interesting note there. All right, so he gets into the Q&A. He was asked about, is value dead? Is everything exciting happening in kind of the growth investing basket? Pabrai has answered this before. He says value and growth are two sides of the same coin. You can't separate them. Any business is worth the sum of the future cash it will produce, discounted to present value. If we are paying meaningfully less than those discounted cash flows, then we are engaging in value investing. That is timeless. Okay, that will always, work. Granted, you have enough bets using that approach. If we are willing to pay anything for those future cash flows, anything at all, right? If we're not really paying attention to price, then usually that has led to not such good results in the long term. So really what Pabrai is saying here, value and growth, there's no real difference. The objective is to pay less for something than it's going to be worth. If it's a growth company, you project growth out decades into the future, you can actually pay up for that thing today compared to maybe what other people are willing to pay for it, and still do very well. The issue that I see with growth companies is if you're wrong on the growth, which it's very easy to be wrong on what a company is going to do a decade now, 2 decades from now. If you're overshooting your projections of growth, it's not going to go well for you. So there tends to be more risk involved, more risk of losing money if we're willing to kind of pay up now for these rosy projections into the future. So that's one thing I see there. He goes on in the Q&A, if you are going to participate in auction-driven markets, right? The stock market is an auction-driven market. You have to understand that markets will overshoot and undershoot regularly. All right. There's a lot more price fluctuation than there is fluctuation in the value of the business. Okay, the underlying business value. So there's two kind of, follow-ups to that, two implications. One, we must not be leveraged in the stock market. Okay, because if we're leveraged and the market is undershooting, perhaps significantly undershooting, which means, the market crashes, we go in, the market tanks. You can get knocked out of the game if you're leveraged, if you're borrowing money to buy stock and the market tanks, you may still own solid businesses within that portfolio, right? Businesses that you want to own forever. But your broker can call you up and say, hey, you got to sell your positions because the price is down. You're borrowing money from us, and this is too risky for us. So you need to pay us back and get out. And that tends to happen at the worst possible times, right? When stocks are cheapest. So leverage, it's very easy in a market like this where, everything just seems to keep going up. Everything. Just up, 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 up. That's the time when people say, oh, this is easy. This is easy to make money in the stock market. I'm just going to borrow some money so that I can juice my returns, so I can get rich faster. Okay? And I think a recent chart that Michael Burry put out on Twitter shows, margin debt as compared to kind of stock market price and kind of where we're at now and the delta between those two. It's a very interesting time. So be careful out there. The second implication is that the greatest opportunities are when fear is highest, okay, which is something I just alluded to. But at maximum fear, that's when the fewest number of people are willing to own stocks, okay? Everybody who's going to get out has gotten out of the stock market. Prices are lowest. You have the least risk when the prices of assets are lowest, okay? And the risk is really that relationship between price and value. So it's such an interesting space, investing, where when people perceive that risk is highest, it's when it's actually lowest. It's really an interesting psychological phenomena. He talks about how Munger says there's no need to have a portfolio of more than 5 stocks. Okay, so he was asked about diversification. Munger thinks, if you're in 5 businesses that you know really well, and you've bought them at a significant discount to what they're worth, you don't need to do more than that. You don't need to have your eggs in more baskets than 5. And then Pabrai talked about his personal account, right? So he manages a fund. He likes to have about 10 positions in that fund at around 10% on a cost basis. In his personal account, he's much more concentrated than that. He says, in my personal accounts, meaning IRAs and other personal accounts, he rarely has more than 2 or 3 stocks in those accounts. Sometimes I just have 1 stock, right? My highest conviction idea. So that's pretty interesting. I mean, Munger has 3 stocks in the family portfolio, right? Berkshire, Costco, and a stake in Li Lu's Himalaya Capital. But those aren't really 3 stocks, because obviously Berkshire owns a bunch of stuff, both private and public. Li Lu has a whole portfolio of different companies, so it's not really 3 stocks. But Pabrai, 2 or 3 stocks in his personal account. So that caught my attention. That was interesting. With Pabrai funds, because it's other people's money, he's told investors that he won't put more than 10% at cost into a single idea. Now, sometimes it happens that 1 or 2 positions grow to be a pretty substantial chunk of Pabrai funds. He says 2 positions have grown to 60 or 70% of the portfolio. And he's been reluctant to cut them back when that happens. Okay. So the risk management is really at the buy, at that kind of no more than 10% threshold. But he wants to let those winners ride as far as possible. He says it's hard to beat the index with 20 stocks at 5% each, right? So if you make a 5% bet on 20 different companies, Pabrai thinks it's quite difficult to beat like an S&P 500 index doing that. He really thinks you need to be more concentrated than 20. Probably at a minimum somewhere around 10. Pabrai, ideally, if he's not managing other people's money, 2 or 3 is kind of his gold standard. Really what we want is a convergence with businesses that we understand very well. So that's one thing we need to have, businesses we understand very well. And those businesses being very undervalued, okay? That's really what we're looking for. We know this well. It's cheap. That's kind of the sweet spot. So his new framework, businesses with long runways that can be bought at only a slight discount to intrinsic value. So this isn't the 50-cent dollar bill thing that Pabrai was doing for like 20 years, okay? It's a whole new framework. He doesn't need a big margin of safety when it comes to these long-term compounders, these spawners that he's been talking about. He wants to have a slight discount to what he thinks they're worth. But I imagine he'd probably even buy them at fair value if he saw, a very long runway, a big moat, a great long-term compounder, the characteristics that define these great long-term compounders. We really only need 1 or 2 out of 10 to knock it out of the park with our portfolios, right? You look at Nick Sleep and how, it was really Amazon that drove the whole return situation for Nomad investment partners. It was Amazon, okay? And of course, over the last 20 years, Amazon has probably been the best performing stock in the stock market. I just retweeted something on Twitter. Someone had shown, I think it was over the last 30 years, which had been the best performing stocks. Amazon was actually number 2. Monster Beverage was number 1, which surprised me. Of course, Monster has been written up in Chris Meyer's 100 Baggers. So I am familiar with the company, but just going back to this, we only need 1 or 2 out of 10 to do very well. So that's something I'm really trying to drill into my head. Pabrai talked about the Nifty 50 back in the early 1970s. There were these 50 companies that everyone thought, all right, we got to buy into these regardless of price because these companies are going to change the world, right? They're going to dominate the market for decades ahead. Now, there was some confusion about whether Walmart was part of the Nifty 50, okay? And that point is really important here. If you had bought Walmart in the 1970s as part of the Nifty 50 with only a 2% bet, right? So say you had 2% of your portfolio in each of these 50 companies, right? The Nifty 50. You would have beat the indices, if you just had Walmart in there, okay? And that's a 2% bet. So you imagine if you get something like a 10% bet, or 2 or 3 companies in your portfolio, and one of them happens to be Walmart, or one of them happens to be Amazon, you just knock it out of the park. So that was kind of an interesting. If Walmart wasn't in there and you had bought these 50 stocks at 2% each, you wouldn't have beat the indexes. You wouldn't have done very well, in fact. So, you really can't buy companies regardless of price, no matter how great they are. It's critical to, practice value investing, to buy things for less than they're worth. Even if just a little bit less than they're worth, in the case of these spawners that Pabrai is hunting for. So Pabrai talks about the Turkish warehouse company, Reysas. Okay, he didn't specifically say Reysas, but I'm pretty sure that's what he's talking about here. He says, all I have to do is wait until 2030, right? And check on it, then go to sleep for another 10 years. So Pabrai wants to own these companies where he can go to sleep for a decade. He knows he's got a great management team, great capital allocators. He's got a great business with a fantastic moat. He's paying less than it's worth. And just check out, right? Don't get so involved. Don't Don't look at it every quarter. Get scared out because there's some news that isn't actually super important in the grand scheme of things, and just decide, okay, I can do better somewhere else. Too much tinkering is bad news for long-term wealth creation. Along those lines, the number one skill you need to do well as an investor is extreme patience. This is something Joel Greenblatt talks about as well. I think his latest, little book or whatever, was all about patience. It's the big secret. And as technology gets better and better, as we have Robinhood in our pockets and can, look at apps second by second, patience becomes harder and harder. So the delta between the performance of people who, feel like they need to do more and more to get great returns, and people who are aware of the value of extreme patience, that delta is just going to get bigger and bigger, even though we have more and more information. It's not actually benefiting investors necessarily that we have more and more information, because more and more information just means you feel compelled to act faster, right? That's really not where we get our edge as value investors. Pabrai talked about Twitter and Google and Netflix and said, they could monetize a lot more than they are without losing many users. And he talked about how Netflix increased, I think, the monthly membership by like $2, right? And Pabrai thinks, nobody's going to be leaving Netflix because they have to pay $2 more per month. So that could point to a great business where you have the ability to raise your prices without impacting your users meaningfully. This is the last piece of the Q&A. He was asked point blank, what is your highest conviction stock pick right now? I was thinking, wow, that takes cojones. I mean, it seems like most talks, Pabrai kind of starts it by saying, you can ask anything, just don't ask me, what I own or what I'm buying right now. So somebody asked, and Pabrai, of course, said, I will duck that question. And of course, this student came back and was like, oh, come on, man. Like, we're an investing club. Like, give us something. Again, cojones. So Pabrai, I've never heard him answer that this way before, so it was interesting. The problem is there's only downside for me if I'm going to give you a stock tip, all right? There's no upside. Anything I own could go to zero, right? Anything can happen in the world of business. Even if you have the best business in the world, something could come along and destroy that business. That's capitalism is brutal. So anything I own could go to zero. I cannot have Babson students lose money on something that I tell you, right? And that makes total sense. There's no upside for Pabrai to do something like that. The second thing is that it's a really bad idea to buy something when someone else tells you about it, okay? To get a stock tip and say, oh, I'm going to plow a bunch of money into this because this guy or this girl thinks it's a great business. It's a great investment. And, the reason for that, a big part of the reason for that, if you get a stock tip and you plow a bunch of money into it, and something comes across the news negative about that company, where is your conviction to hold that company, to try to understand the big picture ramifications of this event that's being talked about in the news? How do you navigate that as someone who now owns this stock, owns this company? So you really need the conviction that understanding a business provides in order to hold these great businesses for a long time. And you don't get that conviction by somebody telling you, hey, this is a company I bought recently, take a look, or you should think about buying that. And I was surprised also how Pabrai followed this up. partly surprised, partly not surprised. He says, if you are a know-nothing investor, just getting started, dollar cost average into the S&P index, okay? And, this is what Buffett says at his annual meetings when someone asks. I think Tim Ferriss asked him in like 2006 or 7. He laid out kind of some details about his personal financial situation. And Buffett basically said, just dollar cost average into the index, into an S&P 500 index fund. The reason I think that's interesting is back in 2012, I think it was, at Ivy College, Pabrai did a talk there, a Q&A, where he basically laid out this framework. If you have an IQ of 50, right? So you're kind of the village idiot, right? Buy an S&P 500 index fund and just keep doing that. Dollar cost average into there. If you have an IQ of 70, right? You're a little smarter than the village idiot. Buy Berkshire Hathaway, okay? Because it's very likely that Berkshire will outperform the S&P 500 index over the next decades. Now, Berkshire definitely has not outperformed the S&P 500 since 2012, so that's kind of an interesting thing there, but doesn't mean it won't moving forward. Now, if you have an IQ of 100, right, you're of average intelligence. Look at what great investors are buying. Figure out, what you can understand, or even better, shamelessly clone them, right? So set up some rules for yourself about when you're going to buy, when you're going to sell, which super investors you're going to clone, and make it automatic that way, okay? But, that way, instead of owning the 500 largest U.S. companies, you're owning a basket of companies that great investors have recently bought. And it stands to reason that, you have a good chance of outperforming the index by doing that. And then if you have above average intelligence, you can actually look at what these super investors are buying, right? Start there. But then you can go deeper into each company and decide which ones you want to own. So that was the framework back in 2012 that Pabrai laid out. But now, it sounds like he's saying, just dollar cost average into the S&P 500 index. It's definitely easier advice, right? It's pretty straightforward to do that. Maybe that's why Pabrai suggested that. And then finally, he gets into the 3 variables that drive long-term creation of wealth. And this is really the formula for compounding, right? Compound growth over time. One variable, how much money you're putting into the pot, right? Capital. How much capital are you contributing to your portfolio? Number 2, length of the runway. The more years you have to compound that capital, the more money you're going to have, right? It's that compound growth curve. If you look at the compound growth curve, it gets so much sweeter the further and further out you get. I mean, it's like a hockey stick growth curve. So the longer you can make that, the more of the exciting part of the hockey stick you're going to capture. And then the third one is the rate of return, okay? And the 2 most powerful ones are rate of return and the length of the runway. Those are kind of the exponential factors. The capital infusion is a linear factor, okay? You put twice as much in, you're going to get twice as much out. With time and with rate of return, it's an exponential output. So that's really where we want to be focusing in this game. Lengthening our runway, getting started as early as possible, and getting the highest rate of return that doesn't put us in undue risk of losing money. That's a very important piece of that. And it's really all about the number of doubles, right? We want to double our money in the shortest time frame possible. Again, with an eye on risk, with an eye on avoiding things that will lose us money. So that's it, guys. Just want to do a quick recap of Pabrai's talk at Babson. Thank you all for being here. Big salute to Monish Pabrai for putting out all this great content. And I will see you all in the next video. Take care.